In this video we're taking a look at Academy Sports and Outdoors, or ticker symbol ASO. And honestly, I see this company becoming a $70 stock on the short term. What I'm saying is, this value investment might be giving us a 55% upside on the short term. That is some juicy potential, with very little risk attached to it. Let me explain. By first giving you a company overview. Just like the company's name suggests, the company sells outdoor stuff like hunting, fishing, camping gear. It sells sports gear for popular pastime sports like baseball, basketball, football, soccer. It sells apparel for both men and women. And of course, since the company is located in the US, it does also sell firearms. However, do not expect to buy any fashionable items here. We are talking about a company aiming for the US market after all. Customers can either go to one of the 259 currently open Academy stores, or they can purchase items online for either at-home delivery or in-store pickup. Talking about stores, the company still has quite a bit of white space to still cover. You see, originally the company started in Texas, and the company is doing quite well with their coverage in this enormous state, with 106 stores currently operating in Texas. Keep in mind, however, the company hasn't opened any new stores since 2020. You can probably guess the reason why. It was the Roni Roan bad boy, of course. But the company has opened one store this year, and they stated that it was one of the best store openings we've ever had. Actually, my lawyers made me say that it was one of the best, because we couldn't quite prove whether our first store opening was better. But this new store was the best one we've opened in a while by a long shot. I am heavily paraphrasing here, since I was listening to the Q1 earnings call while I was walking my dog. My apologies to Mr. Manager at Academy Sports if I twisted your words slightly. Anyways, that one store opening was a hacking success, and apparently the company is opening at least 8 more stores this year, 2022. In fact, the company plans to open a whopping 100 stores during the next 5 years, which would be a phenomenal growth rate compared to the current 259 stores. We will be talking a lot about growth rates during the valuation part of this video, but before that we first gotta take a look at the financials, so the balance sheet, but also how the company is actually earning money. Let's start with that freaking balance sheet, and honestly, it's hella clean. A lot of cash, which we do like, a shit ton of inventories, which can be a bad thing, but is actually a good thing, since inventories year over year on a volume basis are actually down 10%. Moreover, according to the management, the inventories the company does actually hold are not likely to suffer from markdowns. The company also carries a ton of goodwill, which we do not really like. As a reminder, goodwill is just an accounting trick. It is not something that actually holds value. Whether they carry goodwill on their balance sheet or not, I should be indifferent about. Important to note, the company can cover all its long-term debt with just 1 year of earnings, and all of their long-term lease liabilities are covered by their right of use assets, so that makes sense. Anyone watching this channel is a certified GigaChat, but the big brain GigaChats of you might have noticed that there isn't really any real estate on this balance sheet. But if the company operates 259 stores, how can it not carry any real estate on its balance sheet? Well, that is because the company doesn't own any freaking real estate. Actually, the company leases their buildings, hence the huge long-term lease liabilities post, and they own jack shit buildings wise. Perhaps a shocker, but this is actually a conscious business strategy, and I assume it's because of risk. After all, if a store happens to be a huge failure, and if you're also the owner of that building, you are double screwed. You probably cannot find anyone willing to buy your failed store. While if you lease your store building, you can just decide to move out and move all your fares to another better location. So not owning any physical stores allows the company to be more nimble and carry less risk. Moreover, it also decreases the upfront capital required for starting up a new store. All that is to say, I do like this strategy. As a finisher to the financial statements, the shareholders' equity of this business is 1.5 billion US dollars, so the book value of this business is 1.5 billion dollars. At the current share price of around $45 per share, that's roughly a price to book value of 2.6. Do with that what you will. Now, lastly, before our juicy valuation, earnings. First thing to note, the company has a gross margin of 35%, which is actually a figure I'm quite happy with. Especially since back in 2020, the company managed a gross margin of just 29%. Their net margins are more in line with what you would expect from physical stores, in the neighborhood of 10%. Still really solid, and this figure is trending up over time, me likes. And actually, their revenues are quite well spread out throughout 4 different segments, which in turn make up a total of 16 different product categories. Very nice. Fun fact, Academy also owns 20 different brands, which it also sells in its own stores. These 20 brands result in a total of 57% of the total revenue. Moreover, from their Q1 earnings call, I have gathered that their gross margins are significantly higher on their fully owned brands. So if we investors like profit maximization, which we all should like by the way, then we do want that 57% figure to go up over time. And really, that is their entire business explained in just a couple of minutes. Sure, we haven't discussed every single detail. For example, we didn't even touch on management, but that was never the goal of this video anyways. So now let's quickly get on with my ASO valuation. I start off with the company's 2022 guidance, and actually I take the lowest number in their range, $6.3 in earnings per share. Now we need to grow that figure into the future, and really there are 3 types of EPS growth we can expect for ASO. First, EPS growth by decreasing the shares outstanding. After all, earnings per share equals earnings divided by shares outstanding. So if we decrease that shares outstanding figure, we can increase EPS going forward. And the company is actively increasing the EPS figure by decreasing the shares outstanding by buying back their own shares. Actually, the company has a $700 million share repurchase program outstanding, which at the current valuation would mean buying back roughly 18% of their total shares outstanding over a 3-year period. Quick maths, that is about a 6% average compounded growth rate, so that is the first component of our growth, 6% coming from buybacks. Next up, store growth. The company is planning to build 100 extra stores over the next 5 years compared to the current 259 stores being operational. That equals to roughly a 6% compounded average growth rate over that 5-year period. So 6% in EPS growth coming from share buybacks, 6% coming from new stores. Now onto the last growth rate. This one mainly stems from the improvement in the general profitability that we can expect going forward. For example, through economies of scope and economies of scale. Also just from their existing stores doing more revenue over time. And it's hard to put an exact figure on this one, so let's just give it a conservative 2% growth rate and call it a day. 6% from share buybacks, 6% from store growth, and 2% from general sales go brrr, results in a total growth rate of 14% for the next 5 years. It is safe to assume that this insane growth rate will decelerate going forward, so let's give it a 10% growth rate for the next 5 years after that. And these growth rates make our EPS go all the way from $6.3 in EPS by 2022 all the way to almost $20 in EPS by 2032. If we slap on a market conform PE ratio of 15, which is actually the historical average for the S&P 500, well, then we get to my future price target of almost $300 per share. Holy smokes. Assuming I buy today at $45 per share, that would be a 7x return in 10 years, which is nothing to sneeze at. Moreover, I would argue most of these estimations are actually really conservative. And if we assume a super conservative discount rate of 15%, we get to my intrinsic value today of around $70 per share. So that is where the short-term $70 price target comes from. And my heavy buy target, including a healthy margin of safety of 50%, comes in at roughly $35 per share. That is where I would be willing to buy all the shares I could possibly get my hands on. But at today's price of roughly $45 per share, I would also buy, as in fact I have already done. Today I own just a few shares of ASO at about 2% of my portfolio, and I do hope to build this position up over time. So that was my overview and my valuation of ASO. Now, what do you think of this company? Is it as amazing as I am making it out to be? Or am I missing something major? Let me know your thoughts as well as suggestions for future videos down below in the comment section. And with that said, thank you so much for watching. I love you all. Peace.